Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So I'm not going to go through the percentages and the maps too much. Everything's basically red, right? The only green sector was energy. Everything else was deep in the red, with the risk on sectors suffering the most, like tech, cyclicals, and communication services. Same thing here, guys. We're seeing a rotation into energy and some defensive healthcare plays. Like Eli Lilly and some of the health insurers. Everything else is deep red. So what's going on? Let's take a look at the daily chart of the S&P 500. Yesterday, we closed down 2% on the S&P. This is a massive move. The last time we saw volatility like this was back here. Look at this humongous move to the downside, 2.5%. And prior to that, was right here when we saw this 2.5% move to the downside. Now, interestingly, guys, we managed to hit the lower expected move for the week on our very first day of trading. This goes to show how volatile the markets are. I do track expected weekly moves. The move to the upside was expected to be around 430, and the to the downside was around 413.8. I do post these expected moves in the Discord group, guys. I also post actionable information on how to trade around these levels. And so when we see something like this, when we tag our expected move in the very first day of trading, you can make two assumptions right off the bat, okay? Assumption number one, volatility for the week will skyrocket. Assumption number two is that we could easily see some extremely choppy trading where we go straight back up in the next couple of days, okay? What we've seen in the past, guys, when we hit our weekly expected move on the very first day of trading, or let's say second day of trading, so very early on in the week, we tend to see a bounce off these levels. And as of right now, we're sitting extremely close to filling this gap right here at $411. So on the Tuesday session, I could easily see us continue to go down just to fill this gap and then see some buying off these levels for a bounce back up. Interestingly, guys, if we bounce to the middle of the range of the weekly expected moves, we actually end up filling this gap at $420, $422. So don't be shocked to see some whipsaws like this for this week. I would not be surprised, especially when we have some critical data coming out on Thursday. We have the GDP figures coming out this Thursday right here. And so watch for a revision to the upside. The preliminary GDP figure reported last month was 0.9% to the downside, so a negative number. Watch for a revision to the upside that will put a lot more pressure on commodities and inflation in general. So that will be positive for oil markets and energy stocks. And also watch for unexpected weakness or strength in the jobs market. So if we put all of those things together, guys, it seems to me that it is very possible, again, to see a tag to the very lower edge of this red box zone, and for this to act as a demand zone, because we would fill the gap at this level, and that would act as a demand zone. And from there, if we get good news on GDP, for example, or jobs, we could see a bounce back up on Thursday, tagging the middle of the range, the weekly expected range, and filling this gap. And then on Friday, when PCE comes out, the dreaded PCE, as well as when we expect Fed officials to start talking the market down, we could see the market continue to sell off on Friday. These are not predictions, guys. This is just a forecast based on the calendar that we have today and based on the move that we saw Monday. Anything could happen. We could just continue to sell off, or we could actually go absolutely bananas again and hit the upper edge of this descending channel. We just have to trade the charts one day at a time. Now let's take a look at the triple Qs. Interestingly, guys, the triple Qs have already filled the gap. So I do expect some buying off this zone. We closed below the 125 daily moving average. On the S&P, we're sitting right on top of that moving average. This light blue line is the 125 daily moving average. So again, that could act as a level of support. We're now tagging the 125 daily moving average, and we are very close to filling that gap, and we've already hit the lower expected move for the week. Okay, so be very careful at opening additional short positions here. I did in fact close on my short dated put options On Monday, guys, I made a really nice profit. I made 60% on one put spread and 50+% on the other. And I only held those put spreads for 2 trading days. I opened the first last Thursday and I opened the second last Friday. So that's a really nice return for just a 2 to 3 day trade, right? And we tagged the lower expected move, so I decided to take profits. So I took this screenshot off my phone, I think about 30 minutes before I closed my positions. The positions ended up moving up significantly higher. So the September 2nd spread ended up netting an 80% profit on each leg. And the September 30th spread ended up netting a 60% profit on each leg. But because this was a put spread and not a naked put position, I ended up netting about, I think, a 65% profit on the first put position and about a 50% profit on the second put position. Just around those figures roughly, taking the initial capital from $3,940 to about $6,000. Now, if you guys are interested in following my trades, I do post every single trade that I make in real time in the Discord group. It's $20 a month. If you want to support me, that's the best way you can do that. And I go through my entire trading activity on there, as well as my trade ideas, weekly watch lists, investments, and so on. Now let's go back to the triple Qs. Again, we're seeing this gap fill on very significant volume, right, guys? We had very significant volume the last couple of trading sessions on both the S&P and the NASDAQ. We're now sitting at a somewhat of a demand zone right here. This acted as resistance in the past, and once we broke through that, we moved sideways for a little bit. So I could see some demand coming back in at this level, especially with this a really sizable gap to the upside here. Now let's take a look at the HYG, the high yield bonds, also known as the junk bonds. Now this is a very important chart to look at because it alerted us this year to every single sell-off before it happened, right? It alerted us every single time back here in February, again in April, late May, early June, and again last week. I did mark these divergences on the chart here in the S&P just to show you guys how beautiful this signal has been playing out this year. After we got the first signal, we had a 10% sell-off. After we got our second signal, we had a whopping 13.5% sell-off. After we got our third signal, we had another whopping 12.5% sell-off. And so far, after the last signal that we saw, we had a 4% sell-off so far. So expect more selling to come, a lot more choppiness to come. Now, I'm watching the HYG again for divergences to the upside, okay? So, for example, if we see the HYG close a green today, while the S&P 500 closes down, that would be a divergence to the upside, and that would indicate that a small bounce is coming in the markets. We haven't seen that just yet. We're just seeing a continuation of the selling on both of these products. Now let's take a look at the VIX. Another beautiful, beautiful signal. Again, this signal had a 100% track record of marking tops and predicting sell-offs. The way to capture this signal, guys, is one, we need the VIX to form a low. And number two, we need to see a bullish crossover on the PPO every single time these criteria were met. The stock market sold off very sharply and very quickly. So let me add the S&P 500 to this chart to show you guys what I'm talking about. Right over here, the top came in just a couple of days later, and then we had a sell-off right here in June. Right here in January, it marked the top right on time, and then we had that massive sell-off. Again, it marked the top perfectly. In February, we had that sell-off leading into the Ukraine war. April, it marked the perfect entry for a short position again, and then we had that insane sell-off. Exact same thing here, guys, in early June, and again here it marked the top perfectly. These black vertical lines, guys, are lined up so that they sit at the very bottom of the PPO reading. So when we bottom on the PPO, that's when I put in this vertical line. This signal is only confirmed if we see a bullish crossover, and that is what ended up happening last week. Now let's take a look at the dollar index. I did forget to talk about the dollar index in my last video, unfortunately, but in prior videos I did talk about breaking the 107 level. I did say, guys, watch for a break above 107. As soon as we did that, we ended up having this massive rip in the dollar index and a massive sell-off in the stock market. This level made sense to me for a couple of reasons. One, we had a double bottom right here, and we had divergences on the smaller time frames. We had one divergence right here and another very significant divergence right over here. And now we're seeing these divergences play to the upside. Now, the second reason was that this was a clear supply zone, right? We had a bunch of wicks here. Price tried to test these levels and it got rejected continuously. But as soon as we managed to close above 107, we saw a very massive surge in buying in the dollar index. Now, the dollar index has a very strong negative correlation with the stock market. So, and it makes sense, right? People dump their stock positions and they move into cash, and that drives the dollar index up. And that's exactly what we've been seeing so far. Let's take a look at the 10-year yield. We finally had our close above the 50-period daily moving average. We are now on track to make the head and shoulders top that I was talking about for quite a while now. We need to see a very clear rejection right at this zone for this head and shoulders top to actually be confirmed. Otherwise, this could end up being a brand new uptrend in the 10-year yield. The 10-year yield, again, guys, is very sensitive to inflation and economic activity. So when the 10-year yield starts to move up, it puts a lot of pressure on the stock market and the economy in general. Now let's take a look at the 2-year yield. The 2-year yield is significantly more sensitive to Fed action, to the federal funds rate. We are now forming a very obvious bull flag. We need to see a close above 3.37% for this bull flag to be confirmed. If we see that, once we see that, brace for a significant bout of volatility to come into the market and for yields to shoot up. That would obviously put a lot of pressure on the stock market. Now, I want to show this chart again. This is the 2 to 10 yield curve, and it continues to be inverted, but we are seeing some signs of steepening, which is actually a bad sign, not a good sign, right? Now, the inversion of the 2-10 yield curve occurs when the 2-year bonds begin to net a higher yield than the 10-year bonds. And that occurs when bond traders start selling the 2-year bonds and buying the 10-year bonds. This only happens when bond traders and market participants in general are anticipating a recession and are extremely fearful about growth in the economy. So they end up dumping the short-dated bonds and piling into the longer-dated bonds. And over the past 100 years plus, this yield curve inversion signal has had a 100% track record of predicting recessions. Usually after an inversion occurs, a recession follows in the next 6 to 18 months. Every single time we've seen the yield curve invert, we had a recession. Even prior to the 2020 crash, right here, we had an inversion in August of 2019. Even though absolutely nobody could have seen the global shutdowns coming 9 months later, the yield curve did predict that a recession was coming. So even if the thing never happened, the yield curve was predicting that the economy was weakening and that a recession was coming. We had the exact same thing happen in 2006. We had an initial inversion, just like we saw earlier this year in March. And then we had a deeper inversion in early 2007. And once we started to see the yield curve begin to steepen, that's when we started to see the stock market begin to sell off significantly. Right as the yield curve began to steepen, we had this sell-off, and as it continued to steepen, we had the most significant sell-off come later. Once yield calmed down right here and then began to move back up, we had the second leg of selling come in. The exact same thing happened right here in 2000, guys. We had an inversion right here in early 2000. And as the yield curve began to steepen, we had this sell-off come in. And we're now seeing early signs of the yield curve basing and beginning to steepen again. So watch out for a massive sell-off to come in let's say the next 6 to 12 months. Now, interestingly, as the yield curve bases, we tend to see the stock market actually rally off this base. And then when we start to see the yield curve begin to steepen, that's when we get that really massive sell-off and the beginning of a new bear market. So don't be surprised to see the stock market actually maybe put in some choppiness in the next couple of months. In September and October, we do tend to see a very big jump in volatility in both of those months in midterm years, and this is a midterm year. In fact, let's take a look at the seasonality chart for midterm years. And look at that, guys. We tend to see this massive sell-off towards the end of August, early September, and a lot of choppiness and selling in September as well as October. And then a really nice rally in November and again in December. So we could see some choppiness in the stock market as this yield curve is basing, and then a beautiful rally in November, December. And then as the yield curve begins to steepen, let's say in January next year, that's when we might start to see the real bear market start. Now let's take a look at Apple. Apple had an insane run from the June low right here to the top, 35%, absolutely insane face-ripping rally. The last time we saw something like this was back in 2008. Right over here, guys, in early 2008, we saw this sell-off in the stock market and in Apple, and then we had that low form in around March, and then we had a massive rally in Apple. Unfortunately, what ended up happening was that all of these investors and traders that piled into this trade as a defensive play ended up paying the ultimate price, because what ended up happening is that Apple held on for a quite a while, right? It held up for quite a while. It did not sell off as aggressively as the rest of the stock market, right up until the bottom fell off the market, and Apple lost more than half of its value in a matter of 30 trading sessions. So basically in a month and a half, Apple lost more than half its value. And unfortunately, this is very typical of bear markets. We do tend to see the Apple trade get very crowded. And sadly, that's the exact same thing that we're seeing right now. So be very careful, guys. This could be just the beginning of the end for Apple's outperformance of the stock market. And we do have a bunch of gaps on Apple. We have a gap right here at 165, another gap at 157, and then we have this key pivot point at $150, where we saw it act as support several times in the past. And once we broke through it, it acted as resistance. And once we broke through it again, it acted as a level of support, and we bounced off that level. So watch for Apple to pull back all the way to $150 over the next, let's say, couple of months. Now let's take a look at Tesla. Surprisingly, Tesla is holding up very well. It actually outperformed the NASDAQ. The NASDAQ saw a significantly stronger sell-off than Tesla this last trading session. So this is a good sign for the bulls. I did say in my last video that we need to see a lot of buyers step into Tesla at $840. We need to see Tesla hold these levels for bulls to have a chance for a nice rebound. If this $840 level breaks, watch for a retest all the way down here at $770. Now let's jump into BBBY, Triple BY, Bed Bath & Beyond. Again, in the last few videos, I did say that you should not be surprised at all to see Bed Bath & Beyond sell off all the way back to $10. I do expect to see Bed Bath & Beyond hover at this level for quite a long time. We're so close to filling this gap at $8 right here. So we could see that happen this Tuesday. In fact, we could see this gap getting filled as we see the S&P 500 also fill its gap. Now, I'm going to do something a little bit different this video, guys. I want to talk about some news. This is from Bloomberg. Saudi prince says oil disconnect may force OPEC plus action. Now, I did actually go into the article and read it. And what the Saudis are basically saying is that there's a clear disconnect between the oil futures markets and the actual demand in the global supply. And there's a very, very tight supply globally, and demand continues to be strong, especially in Europe as they get rid of all of their contracts with Russia. So again, guys, we're starting to see this drumbeat from the media, from governments, and it's obvious that the agenda is to push oil prices up. And another article here, guys, from Reuters: Saudi cuts crude supply to some Chinese refiners in July. The Saudis ended up cutting some supply from China and rerouting that supply to Europe because actually China is getting cheaper oil from Russia. Not because the Saudis don't want to sell oil, it's simply that the Chinese are getting cheaper oil from Russia. And so that Russian oil supply is getting diverted from Europe to China, and Saudi supply is getting diverted from China to Europe. So nothing really major is going on, but again, we're seeing a lot of media play this up. We're seeing governments, the Saudis, the Russians, beating the drum on this. So do not be surprised to see oil start to move back up. In fact, let's take a look at the chart for oil. This is Brent crude oil, and I did talk about this chart for quite a bit now. It is obvious to me that we are forming a double bottom right here with a very minor divergence on the PPO and a larger divergence right over here, right? We had significant lower lows, but the PPO was actually flat. So this is a basing formation for oil. We could see oil shoot back up all the way to 105, even 110. In fact, if we take a look at the weekly chart, guys, the middle of the Bollinger Band is sitting at 108, and we're now seeing momentum push back to the upside, beginning to push back to the upside. It is clear to me that oil might be basing here, and that will put a lot of pressure on inflation as well as on the stock market. In fact, from a long perspective, my favorite play at the moment is Exxon Mobil. We have this absolutely enormous bull pennant on Exxon Mobil. And remember, guys, Exxon Mobil is the largest energy company in the US. It is basically the Apple of energy. And so far, year to date, it had the highest alpha. So it had the highest risk-adjusted return in the entire energy sector. And the way you would calculate that is you take the year-to-date return and you divide that by volatility. And because ExxonMobil has some of the lowest volatility in the entire energy sector, and it kept on pushing up, yielding year-to-date a 55% return, the stock, in my opinion, has one of the best setups for a long trade. I am still waiting for a break and a close above this descending line for a confirmation of this bull pennant. I did talk about this stock a lot. I did say that it is obvious to me that a lot of buying is occurring at these levels. This does not look like distribution to me. It looks like accumulation. So there's this ghost pattern in the stock market where I'm seeing a lot of money flowing back into energy, flowing back into the inflation trade. So slowly we're seeing this this narrative that the Fed is going to pivot and that inflation is peaking. We're slowly seeing that narrative getting eroded. We're seeing market participants beginning to pile onto the other side of the trade, being bullish on inflation and energy. There are many ways to structure this trade to make anywhere from 100 to 1,000% profit on this stock. So again, guys, if you're interested in following my trade ideas, my investments, my positions, and all of that stuff, please check out the link in the description. Now let's jump into the fear and greed. We're sitting at a neutral reading of 46. We're very quickly unwinding all of that greed that was in the market. In fact, guys, I did say back here that we should expect that fear should top around 58. And look at that, it ended up topping at 57. And that makes sense because if you draw a resistance line, a trend line on fear and greed, we should have seen a reversal to the downside at 58. And we saw that at 57. I expect that greed will continue to flow out of the market. We had extreme greed reading in the short term, and that was obvious in the put to call ratio. and the overall positioning in the market. Now, market momentum is now flashing a fear reading. I could see a bounce back up from the 125 daily moving average again off of these levels right here as we fill this gap and begin to possibly move back up to fill this $422 gap on the S&P 500, and then possibly have a double top or a divergence or something like that that continues the selling to the downside. Stock price strength is now turning back down from the 0% line. I did say to expect that in a bear market for the stock price strength to begin to lose a lot of steam at the 0% line. This continues to indicate that we are still in a bear market. Stock price breadth, I did warn a lot about this. I was happy to see that breadth was basing for a long time, but as soon as I saw a break below the previous low right here in August 9th, we had a negative reading of 1,650, and once we saw a break below that to a negative reading of 1,670 on August the 17th, I did warn that the market was flashing a sell signal. So look at that this was August 17th. We had that divergence on the S&P and the HYG. We had a bunch of indecision candles here. We had a rejection of the resistance line and the 200 daily moving average. So a lot of things were stacking up to indicate that a significant sell-off was coming, and that ended up happening exactly as you would expect. The put to call ratio, we had this surge in put buying in the last couple of trading sessions, which makes sense. We had a massive sell-off in the stock market. Again, market volatility is pushing back up. We might see a rejection at the 50 daily moving average, right? That's common. We had that right here in November. We had that happen again in early January. So we could see again a rejection of this level as the market starts to see some buying of the 125 daily moving average. This, among many other reasons, including the fact that we tagged the lower expected weekly move, prompted me to close my put position and take profits. We're also seeing safe haven demand move up, right? We're seeing bonds beginning to outperform stocks as stocks sell off. We're seeing investment grade bonds again outperform junk bonds as junk bonds sell off. What do we have this week in terms of economic events? Tuesday morning, we have the S&P 500 manufacturing PMI. Wednesday, we have the durable goods orders and core capital orders. Thursday, we have the jobs numbers and the GDP figure. These will be market movers. And by far, the most important market moving event of the week is going to be Jackson Hole and the inflation drop on Friday. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.